Imagine earning money while you sleep. Sounds too good to be true, right? Well, with dividend ETFs, it's not just a dream. In this video, I'll show you how to start investing in these powerful funds and unlock the secret to passive income. So, what exactly is a dividend ETF? Well, an ETF, or exchange traded fund, is a type of investment that holds a basket of assets, like stocks or bonds. Think of it like a pre-packed meal, except instead of food, you're getting a mix of investments. A dividend ETF in particular focuses on stocks from companies that regularly pay dividends. These payouts are typically cash, and you'll receive them just for holding the ETF, without having to do anything else. Why should you care about dividend ETFs? There are a lot of good reasons. First off, they offer income generation. By investing in dividend-paying stocks through an ETF, you can earn passive income, typically on a quarterly basis. Imagine getting cash in your account while you're out enjoying life. That's the power of dividend ETFs. Plus, you're not relying on just one company. ETFs allow you to invest in many companies at once, spreading out your risk. So, if one stock drops in value, it's less likely to hurt your entire investment. Another reason to consider dividend ETFs is their potential for long-term growth. Over time, the dividends paid out by companies can increase, helping you keep up with inflation. And if you reinvest those dividends back into more shares of the ETF, you're tapping into the power of compound interest, growing your investment even faster. Think of it like planting a tree. It starts small, but with time, it grows stronger and larger. All right, now let's talk about how you can choose the right dividend ETF. First up is yield. The yield is the percentage of the ETF's price that's paid out as dividends. For example, if an ETF has a yield of 4%, you'd earn 4% of your investment in dividends each year. But don't just chase the highest yield. A super high yield might look great, but it could also signal that the company is struggling to maintain those payouts. Always check the sustainability of the yield and consider the overall financial health of the companies within the ETF. Next, keep an eye on the expense ratio. This is the fee the ETF charges for managing your money. A lower expense ratio is better, as it means more of your money stays invested. Look for ETFs with expense ratios under 0.5% to maximize your returns. Over the long term, even a small fee can eat into your profits, so it's always better to choose low-cost options. Also, take a look at the ETF's historical performance. How has it performed in both bull and bear markets? While past performance doesn't guarantee future results, it's a good indicator of how the ETF has managed during different economic climates. ETFs that have shown resilience during tough times are generally more reliable. When you're ready to buy your first dividend ETF, you'll need to open a brokerage account. There are plenty of online brokers out there, like Fidelity, Schwab, or Robinhood. Once your account is set up, fund it and start researching ETFs. Use the criteria we discussed earlier to find one that suits your goals. Then, simply place your order through your broker's platform. Once you've bought the ETF, consider setting up automatic dividend reinvestment, DRIP. This allows you to reinvest the dividends you earn back into more shares of the ETF. Over time, this can really accelerate your investment growth without you having to do anything. It's like letting your money snowball. What starts as a small snowball rolls into a bigger one with time. Now, let's talk about common mistakes beginners make when investing in dividend ETFs. The first mistake is chasing after high yields. A high yield can be tempting, but it could also mean the ETF is risky or the company is in trouble. Don't just go for the highest yield. Look for a sustainable one that aligns with your goals for stable income. Another mistake is ignoring fees. Expense ratios might seem small, but they add up over time. look for low-cost ETFs to keep your investment expenses down. Even small differences in fees can make a big difference to your long-term returns. Diversification is key. Don't put all your money into one ETF. Spread it out across different funds to reduce risk. Focusing on quality and diversification, rather than trying to time the market or chase quick returns, will benefit you in the long run. Finally, don't focus too much on short-term performance. Dividend ETFs are long-term investments. Stay patient and let the dividends and compound interest work for you.